The U.S. stock market took a breather after three straight up sessions today. We closed lower across the board by about 0.7%. Some of that was just simply profit taking. Other portions probably dealt with concerns over the U.S. economy. President Trump did come out today and talk a little bit tougher about his negotiations with China, suggesting that he's willing to take short-term economic pain in order to tackle the larger issue with China longer term. We also had some earnings announcements to deal with. Home Depot and Baidu actually came out and surprised to the upside, but of course there were some that were missing to the downside there as well. Of course, we do have Jackson Hole on the horizon for the Fed symposium coming up very soon to see whether the Fed is interested in lowering interest rates yet again. So we'll talk about all of that. We'll also get into our trade application example from a stalwart healthcare company that's starting to look a little bit more bearish on the charts. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 20th, 2019. First of all, if you're new, welcome aboard. Remember to go to YouTube, click on subscribe while you're over there. Make sure you check out our description area where you can sign up for our email distribution list. In addition to that, we're heavy users of Twitter. I would encourage you to follow me at Brandon Van Zee. Also, for those of you that click like and retweet on these Market Outlook related posts, we really appreciate that. Lastly, we do have a presence on Facebook as well. Feel free to join our group at the web address embedded in the logo in front of you. All right, with that, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us. As a reminder, this is just our chart set up to look at all four of the equity markets here in the United States side by side. So that way we can kind of distinguish if there's any differences in the charts. Right now, we do have bearish postures across the board. So that's story number one. Remember, this has been a very choppy couple of weeks. Actually, it's been probably 3 or 4 weeks at this point. But that does have the tendency to change the posture and flip it back and forth between bullish and bearish and bullish and bearish. And so we've been kind of going through this dizzying effect of that here recently. And remember, that's not David or I's opinion. We're basically just reading this market forecast technical indicator. So, obviously you can have a variety of opinions regarding the short term, the intermediate term, or the long term. But for our purposes during this particular presentation, our posture from an intermediate term perspective, according to the market forecast technical indicator, is now bearish across all four of our charts. Now that's new for 3 out of the 4. So we have the S&P 500 in the upper left, the Dow Jones in the upper right, the NASDAQ composite in the lower left. Notice that the colored background of the charts yesterday were green, and today they are now red. So as of yesterday, we had a bullish posture and it reverted back to bearish as of today. Now the Russell 2000 is a little bit different. The Russell 2000 has been our lagging index for much of the last year or so, and it continues to be the case here even in the short term. So despite a couple of really nice sessions for the small caps, we actually retain that bearish posture the entire time. So you didn't have the posture flip back to bullish for just one day there like we saw with the other indices. So for the most part, as I mentioned last week when I was going through these presentations, the path of least resistance continues to be the downside. Now, just because that's the current pathway, and the reason I say that, you can look at the moving averages. They're all colored red right now, which signifies price below a falling moving average. So that is true. We are still struggling to get up and through that downward trending moving average, and that may represent resistance for a while. On the other hand, at least we're not plunging day after day after day after day. That becomes a little bit more concerning. It becomes a little bit more of a self-fulfilling prophecy to a degree as well. Remember, the economy, for all intents and purposes here in the United States, has actually been quite strong. But there will be plenty of times where the stock market gets in a foul mood, and we've seen a few of those moments here more recently. And if that sentiment starts to pick up and more people start to believe that we're heading for disaster, then all of a sudden consumers stop shopping and the economy starts screeching to the halt. Some consumers are even reading stories on the front page of their hometown newspapers about the inverted yield curve. Now, let's take a step back and take a deep breath on that. Remember, first of all, the inverted yield curve happened for less than 1 day. Right now, there is no inverted yield curve, at least if you're looking at the 10s and 2s, which is the main one that folks are looking at. So remember, that did occur on an intraday basis, but we didn't close in that particular condition. And so right now, I don't know if the yield curve is necessarily screaming recession. And even if it is, what history has suggested is that it's oftentimes a year after an inversion takes place or thereabouts before we start seeing some significant deterioration in the economy. So we don't want to get carried away with things in the short term. There could very well be some decent upside potential if we can get through some of these short-term hiccups here in the next, let's call it, couple weeks or months. But typically going into the end of the year is actually a very bullish time period from a seasonal perspective. And right now I don't have any reason to believe that that can't be the case going forward for the U.S. markets as well. Let's go ahead and take a look at our next chart setup here. And this one will be our 3 green arrows chart setup. And so this is chart 4C for those of you that are premium members following along at home with our charting package. As you can see at this current time, we don't have any of these 4 charts with either 3 green arrows or 3 red arrows. We're closer to 3 red arrows. We're especially close here on the Russell 2000, but that is noteworthy and something that I should report to you today because there was a change in that particular chart. Notice that on the Russell 2000, we established a green arrow on the MACD histogram. Remember that kind of is a judgment of momentum. So there was a couple of good days there out of the Russell 2000 here recently to kind of push that MACD up to a positive arrow there. But we retain our red arrow on the moving average, which is the 30-day moving average in this case, and we retain our red arrow on the stochastics, as you can see down below here. On the other charts, it's a mixed bag as well. We do have green arrows on the MACD histograms on all of our charts that we're showing you here, but we also have red arrows on all of the charts when it comes to the stochastics and the moving average. So as I stated before, we've got work to do. Doesn't mean we can't get it done. The stock markets had to go to work many times over the last 10 years when there was a lot of disbelievers out there that thought this time we're heading for disaster, we're heading for a crash. And what did the stock market do? It figured itself out, it worked out its problems, and eventually found itself at all-time highs. And so right now, yes, we're stubbing our toe a little bit here in the stock market, but I don't think I'm counting it out quite yet. It's just a relatively near-term setback that we're dealing with. And as mentioned before, I think there's a decent chance that going into the end of the year, we could actually see a sizable rally. Let's go ahead and now take a look at our 1040 crossover chart. This is chart 4D now. Remember, this chart goes back a bit further in time. Our other charts that we've looked at so far have been 3 months in length. These charts are 3 years in length, and each one of these candles is 1 week in time as opposed to 1 day in time like the other ones. And so this gives us a full 3-year view as to what the trends look like from a longer term perspective now. And as you can see, things have been reasonably bullish for most of the market. In other words, if you were to exclude the Russell 2000 with its current pink background right now, you'd have to say that things have been going reasonably well for the other 3 charts that you see up here, whether it's the S&P 500, the Dow Jones, or the NASDAQ Composite. Now, some of you, depending upon what your expectations are, sometimes we want the world and we want it now as human beings. But of course, stock market doesn't deliver that to you exactly when you want it. So what I would say is that as investors in the United States, now I know we have a global audience as well, so speaking directly to those of you in the United States right now, we have had it quite good in the last 10 years. And yeah, we might not be lighting the world on fire here for the last, let's call it 2 years, as we've kind of been tracking more sideways than anything. But if you take a look around the rest of the globe, we are still one of the strongest stock markets around. And so I don't necessarily look at this as frustrating because I'm trying to look at it with context and understanding that the rest of the world is struggling mightily at the time when we are holding the line is actually outperformance on a relative basis here. So I don't necessarily mind this. I do know others have a differing view, but keep in mind I'm a dividend growth investor in the end as well, looking at things for the long term and reinvesting my dividends along the way. So if the markets go sideways for a spell, it doesn't really upset me to a large degree like it might for some of you that are a bit more short-term oriented. Not that there's anything wrong with that. So as it stands right now from these longer term views, I think the charts are holding up reasonably well. The only concern right now is the Russell 2000, where we do have this orange line, which represents the 10-week moving average, crossing below this blue line, which is the 40-week moving average. That is known as a death cross right there. But I will also remind you that we had a death cross a couple months ago, and it didn't really lead to disaster. We didn't have any sort of substantial meltdown in the small caps or anything like that. It was just more of a, hey, we're tracking sideways yet again, and we're trying to figure this out. And I think that's kind of where we stand right now. Yes, it's true that the Russell 2000 is struggling more than the other indices, but I don't see broken support here in a major way. I see a sideways channeling index, and as long as we can find some sort of a support bottom here in coming weeks, we could easily be back up at these kind of triple tops here at around 1600 for the Russell 2000 in a very short period of time. So we'll keep our eye on it and keep you informed if anything more disastrous takes place, but right now it just kind of seems like it's par for the course. Let's go ahead and take a look at our next chart setup now, and this will be our 12 grid analysis. As this is loading up, a quick reminder, some of you know that those of you that are paid clients of Market Scholars, David has been attempting to do a live kind of trade maintenance and trade execution portion of the Market Outlook videos a half an hour before the market closes. So that's an entirely new concept that we're trying to test out for you guys. He's testing out the technology on that. I am not part of that testing phase, so we do get some questions occasionally, hey, you know, is this up and running on Tuesdays and Thursdays? And right now it is not. As long as things continue to go as planned, and if David's not running into too many hiccups with the streaming technology and all that, it is something that we hope to launch down the road all of the days of the week, where those of you that have had a paid subscription to Market Scholars will be able to kind of be with us in real time when we're putting through our trade ideas for these videos, whereas those that are not paid clients would then have to continue to watch the recorded version like you currently are. So just wanted to clear that up in case there was any confusion there. So on David's classes, or on David's days to do this video, I should say, which is Monday, Wednesday, and Friday, he will do that live Market Outlook version. And you should have received an email from us if you are already a paid client of ours. But on Tuesdays and Thursdays, it'll just be the same as it always has been, which is a recorded version that we'll then send out to you. Until that changes, and then when it does change, we'll let you know that at that time as well. All right, back into the 12 grid that we're dealing with here. This is chart 4E. This is our intermarket analysis 12 grid. The background colors will tell you whether we have a bullish or bearish posture from an intermediate term perspective using the market forecast technical indicator at this current time. So as you can see, we've got some fairly strong trends on the board, starting with right there in the middle of the screen. I would say the bond market is representing the strongest trends at this current juncture, whether you're looking at U.S. government bonds right here or whether you're looking at foreign bonds right here. Both of those charts are kind of leading the way to the upside right now. And today we had yet another big move to the upside for U.S. long bonds, government bonds. They were up over 1% here today in the form of TLT, if you use that as your proxy to kind of track that. And of course, the opposite of that typically means that interest rates themselves fall. And that is the case up here. You can see the 10-year traded at a close of 1.56% here today, falling a little bit there yet again, and remains in that downtrend for rates. You will see that preferred stocks ticked a little bit higher here today, a nice upward trajectory on that chart as well, with a bullish posture from an intermediate term perspective. REITs were a little bit interesting today. REITs actually ended up having a pretty ugly looking candle today, so we'll want to keep our eye on that situation. That's a bearish engulfing candle up there near a resistance area. Now, the path of least resistance continues to be to the upside for REITs. This particular chart is VNQ, the Vanguard version of REITs. But nonetheless, it's something we want to keep our eye on, because traditionally, when interest rates fall, all else being equal, REITs typically outperform. And so it was a little bit suspicious to see REITs kind of give up the ghost here today, down 0.7%, which was falling in line with the rest of the market on a day when interest rates were down 232 basis points or whatever it was up there. So anyway, that's something that we're going to keep our eye on. Right now, the REITs have been one of the stronger areas of the market from an equity perspective, but it doesn't mean that that can't change. And so if it does, we'll be here to do our best to alert you to that. Other charts that look strong, I would say, are the dollar and gold. Those are your charts on the lower left-hand corner there. UUP doesn't look quite as strong because it's kind of dealing with a bit of a double top here over the last month or so. So it'll be interesting to see where that takes us. You'll also see that today UUP had a bearish engulfing candle there as well, also at a kind of resistance area from a horizontal perspective. So we'll keep our eye on that story. Right now, the posture does remain bullish, and we do have an upward trending moving average there. Gold looks a little bit stronger. Gold actually finished the day higher here today. An ounce of gold will cost you, about $1,517 at this point, at least according to the futures contract here /GC. But as you look at that chart, it's a very strong looking chart. And we've been talking about this trend for quite some time, talking about various stocks, whether it's Goldfields or Newmont or Kirkland or Barrick. There's a number of them out there that have really had spectacular years so far and remain in uptrends. So those of you that are gold bugs and looking for good trade setups, you probably have a smile on your face right now when you look at a lot of those miners charts. But even when you're looking at the bullion chart itself here, or the commodity chart itself, it looks fairly substantial, fairly strong. The only time that we've touched the 30-day moving average here in the last 2.5 months was right here on August 1st, and that worked out beautifully, exactly the way that you want it to, which is it used that upward trending 30-day moving average as a launch pad to continue that previous trend that was already heading to the upside. So gold remains one of those interesting areas to be hanging out right now as well. Crude oil and DBA, which is ag commodities, effectively just held the line today. Not big movements there from those two commodities perspectives. But do note that ag commodities have absolutely been flattened here in the last month or so. So they're probably long overdue for some sort of a bounce, although we haven't seen it initiated quite yet. Let's go ahead and take a look now at our next set of 12 grids, which will be our foreign stock markets 12 grid here. This is chart 4F for those of you that are premium members of Market Scholars following along at home. Now, as you look at this particular 12 grid, you'll notice we're bearish across the board. Every single one of these charts has a pink background, and so the intermediate term posture, according to the market forecast, is currently bearish for all of them. Some of them might look a little bit better than others, but for the most part, it's pretty ugly out there. And remember, part of that is due to what I mentioned here just a moment ago on the other 12 grid, which is the US dollar remains in an uptrend. We remain with a bullish intermediate posture on the US dollar. All else being equal, if the US dollar is strong, foreign securities tend to lag or at least struggle on a relative basis versus U.S. Securities. And so that's where we find ourselves right now. Obviously, there are unique individual stories that take place out there that can change the picture either more positively or more negatively. Some of you saw what happened to Argentina last week as just one example. But for the most part, I would say that the sentiment around foreign markets right now is quite poor, and the path of least resistance for basically all of them. All of them have a red moving average. Even Israel does right now. And so all of them do have a path of least resistance to the downside. So that's not a really good sign of health. Remember, if you want good breadth on a really strong stock market, you'd like to see lots of participation out there, whether it's the small caps, whether it's technology stocks, whether it's foreign stocks, anything that traditionally is a risk-on type of an asset. And that's not what we're seeing right now. In fact, we'll talk about that here as a good segue as we move along now to the U.S. sectors 12 grid. This is chart 4G. And here you'll see we do have some signs of strength in the United States specifically. Now, it's not on the whole. As a reminder, this chart 4G, the very first chart in the upper left, is the S&P 500 as a whole. Right now, as I mentioned in the intro, we have a bearish posture on the S&P 500. But it doesn't mean that there aren't specific areas within the S&P 500 that might be a little bit more interesting. As you can see in the lower right-hand corner, that's where you're finding those green charts. Now, unfortunately, these are what you would deem to be defensive or interest rate sensitive sectors, and a lot of people think of them as risk-off types of sectors. So this is not a risk-seeking market. It's a market that is kind of ducking and covering and looking to hunker down while the storm blows through. And so right now we have the staples, the utilities, and real estate with the green charts. In other words, they do have bullish intermediate postures according to the market forecast. All the rest of the charts do have that pink background there. Now, one other thing that I'll share with you here in regards to that is if we look at the sector selector. Remember, I put this together on Friday evenings in anticipation of my Monday top-down trend trading class. There's actually two parts of the sector selector. This is the part that I share publicly. The bottom portion goes into much more detail, including all the stocks hitting 52-week highs and lows that have various 3 green arrow signals, et cetera, et cetera. Well, one thing I wanted to point out here is that I don't look solely at price action when I'm putting these rankings together, but you will see that my rankings on the sector selector kind of jive very nicely right now with what the market forecast itself is saying. Because if we went back over to the market forecast, you can see that the only 3 green charts on the board are real estate, utilities, and staples. And then when we go back to my ranking system, where I'm ranking it by 10 different technical indicators, well, lo and behold, who's number 1, 2, and 3? It's real estate, utilities, and staples, with healthcare coming in at number 4 there. So again, without a doubt, a very defensive tilt to the market right now, while we're kind of in this slop and chop type of a zone here in the late summer moving into early fall, where we oftentimes do find a bit more volatility in the marketplace. So I guess the big story here week over week was the movement of staples on a relative basis a bit higher there on the ranking system, went from number 5 up to number 3. Meanwhile, you'll notice that financials slipped 2 spots from number 7 to number 9. And again, a lot of that is based off of what's been going on with interest rates. As interest rates have been falling, real estate and utilities have been doing well, and financials have struggled. And when that is the opposite, then of course financials can do a little bit better and real estate and utilities struggle. So understand that relationship there. And if you have a big expectation going forward about where you think interest rates are going to go, then that can help you make your next best bet, so to speak, in the stock market itself from a sector perspective. Kind of pulling up the rear end there is, once again, energy. And most of you are quite well aware of the struggles of the oil and gas industry here, not just recently, but I would say going back a full year, perhaps even longer. We've been seeing energy just in the doghouse the entire time, and it just does not want to kind of stabilize. I did notice over the weekend that Barron's cover article, for those of you that subscribe to Barron's, was a positive story on how cheap oil stocks are right now. So perhaps that'll capture the interest of some value investors out there. But every time a value investor has tried to step into oil and gas stocks in the past, they've ended up regretting it more times than not, as it's been more of a value trap than anything else. But we'll just have to see. A lot of times in the commodity world, the cure for low prices is low prices, is the old saying. And so at some point, if some of these kind of less substantial oil and gas companies start going out of business and less oil gets pumped, perhaps oil prices themselves will kind of revert back higher, assuming that demand doesn't fall off of a cliff at the same time. But that's a process that takes a long time to play out. And so until then, you're probably better off looking in other areas until you start seeing some signs of life from energy. Also, while we're over here on the internet, quick shout out to those of you that clicked like for me the last time around when I did this video on Thursday. 108 of you did that, and thank you very much. Anytime we're up and over 100 there, I'm a very happy camper. So if you can make that a habit, remember, we look at those numbers, David and I do, on a regular basis to determine whether we should be doing these videos on a daily basis or whether they're better off on a weekly basis or what have you. And so, it's your way to vote to encourage David and I to continue to do these videos every single day if you get value out of them. Obviously, if you're not getting any value out of them, don't do anything. But if you are getting value out of it, it's probably worth your 5 seconds each time to watch these half-hour videos to go over and click like on Twitter there for us. And we make it easy for you, for those of you that are watching it directly on our website here at marketscholars.com. Remember, we have that embedded directly below the video, so you can actually click like while you're watching the video. You can do it over here on Facebook for those of you that have that as well. Otherwise, remember, we also pin the Market Outlook post to the top of our Twitter timeline if you're looking for it. So all you'd have to do is go to either David or I's timeline on Twitter, and up at the top, at least during the week, you should see that particular tweet that we're referencing there. So if you want to help contribute to the 100 likes there, we would certainly appreciate that. Also, I taught my dividend growth investing class here today. We actually had a spirited conversation about the technology area of all places. It's not the first place that you think of when you think of dividend stocks, but believe it or not, there's actually some fairly decent technology stocks paying dividends out there these days. And so we had an excellent head-to-head matchup. Remember, the dividend growth investing class is one of those that we offer as part of our 7-day free trial, along with David's excellent technical analysis class on Fridays. And so if you were to sign up for a 7-day free trial with us, you would be able to immediately watch that class that I taught today, in addition to our prior classes that we've taught for dividend growth investing over the weeks. And so if you're interested in doing that, come on up here to the pricing tab on Market Scholars to learn more. And also tomorrow morning, David's got his options inventory trading class going for those of you that are premium members of Market Scholars. That's at 11 a.m. Eastern Time. And then my Strategy Lab class will be at 2 p.m. Eastern Time tomorrow. And boy, oh boy, we've been on a hot streak in Strategy Lab. That's a swing trading class there, exclusively with stocks, where we're either buying stocks to the upside or shorting them to the downside. And I checked because it just felt like we were winning all the time here recently, which is not all that typical. Remember, when you're doing swing trading, oftentimes your win-loss ratio is close to 50%, but it's kind of felt to me like we've been winning the vast majority of our trades here recently. So I went back and checked, and out of our last 14 closed trades from a swing trading perspective in that class, 12 of them were closed with profits and only 2 of them were closed with losses. And so we have had a good string of success there in Strategy Lab. I'm mentioning that because I know some of you that have access to our premium subscription at Market Scholars have not necessarily attended that class because you might fancy yourself more of a long-term investor. But even in the short term, where we have these choppier markets like we've seen here for the last 2 or 3 weeks, those can be fertile conditions for swing trading purposes within the market, where you're basically buying the dips and selling the rips and rinsing and repeating that over and over and over again. So if that interests you and you are a premium member of Market Scholars, feel free to join me tomorrow at 2 p.m. Eastern Time, and we'll try to keep our win streak alive there. All right, let's go ahead and get back on track here on the Thinkorswim platform and talk about our trade application example for the day. I'm going to come on over here. Let's do chart 2B on this one. And this one is a slightly different market forecast chart setup than what you're used to seeing. This one is set up for swing trading purposes. In other words, we emphasize the blue line on this chart, which is the near-term line on the market forecast, as opposed to what you normally see David and I refer to in these videos, which is the green intermediate line. So I want to pull up ticker symbol JNJ. This is obviously a very high quality stock. It's one of only 2 stocks left in the United States with a AAA balance sheet, according to Standard & Poor's, along with Microsoft. So without a doubt, Johnson & Johnson is an elite company. Those of you that have followed me over the years in my dividend classes know that I've anointed Johnson & Johnson as one of my Mount Rushmore dividend aristocrat stocks out there. So I think very highly of the company long term. But remember, things in the short term can be different than what your expectations are over the long term. In the short term, I'm actually seeing bearishness out of Johnson & Johnson. Whether that continues or not is anybody's guess, but as I pull this chart up here, you can see that as of today, with a 1.25% drop in Johnson & Johnson shares, we did revert back to a bearish posture from a near-term perspective. So you can see here that the blue line has now started tracking lower. And so that's what is shading this background color red or pink in this particular case. As of yesterday, it would have been considered bullish, but as of today's bounce down, we've got a little bit of a kablode, as some people would call it from an acronym perspective. In other words, a close below the low of the high day, and that's a bounce down off of a falling moving average. It's not a very healthy looking sign there. Now, obviously anything can happen, but from a technical perspective, we're bouncing down from a diagonal resistance area that's being represented by that 30-day moving average. You can see that we're underperforming the S&P 500 over the last 3 months, as this dotted gold line up here represents the pathway of the S&P 500 over that time period, and Johnson & Johnson has struggled in relation to that. So we've got a couple of different things going on there. In addition to that, we have a little bit of a divergence going on here as well. So remember, on this near-term line, we oftentimes use a near-term divergence mindset. And what I'm referring to in this particular case is, notice that we have peak number 1 on the near-term line on the market forecast right here. That would have been on August 9th. We have peak number 2 right here on August 19th. And notice how this peak number 2 is just a little bit underneath the upper reversal zone of the market forecast technical indicator. Well, note that the price action on those days, represented by this candle right here that I'm circling, and then also this candle right here that I'm circling, price actually went up over that time period. Now, it's not much, but on a closing price basis on this candle, the closing price was 132.04. The closing price on this was 132.25. So you had about 21 cents of upward price action there at a time when the underlying technical indicator is giving you more bearishness. And so that is known as a bearish near-term divergence that we're dealing with there. So I am going to do what's known as a bear call spread on Johnson & Johnson here, just to make sure that we're not getting rusty with our bearish trades out there, because I know most of you feel a little bit more comfortable on the long side of the market, and that's natural, but doesn't mean that we can't do more short-term bearish trades when conditions call for it. So let's go on over here to the trade tab, and as you can see, I've got the trade loaded up down below already. And the strikes that I've selected for this is, first of all, we're dealing with the September monthly contracts here, 31 days until expiration. And I've sold the 135 call, and I've bought the 137 call. It's produced a credit of 48 cents for me, which represent basically a 30% return on risk, which is typically our hurdle that we're shooting for on these credit spreads here. So what we're hoping to accomplish, for those of you that are newer to the idea of selling bear call spreads like this one is our break-even price would basically be 48 cents plus 135. So $135.48 is our break-even price. What we're saying is we want this stock, which is currently priced at $130.60, to stay below $135.48 for the next 31 days. If you believe that's going to happen, then this could be an acceptable trade for you. And just to give you a sense of where 135.48 is on the chart, that would be up in about, let's call it right around this vicinity of where I'm circling with my mouse right here. So if you believe that this is going to lead to further lower lows and lower highs, then coming on up here would be a very difficult task for Johnson & Johnson in the near term, because it would require it to get up and above its highest candle over the last month, which would have been right here on August 13th. So let's go ahead and place that trade by clicking confirm and sending that in, and we'll see if we can get filled first thing in the morning. All right, well, thank you for joining me here today yet again. Remember, if you got value out of the video tonight, please go over to Twitter, click like for us there. But right now, we do have bearish postures across the board. Right now, we'll see if that changes. We have had some posture changes here recently, so it very well could happen again. A lot of it depends upon what sort of news we're seeing from a geopolitical perspective. And once again, we do have the Jackson Hole Symposium coming up here for the Fed as well, so we might learn a little bit more about that. Thanks always as well to Investors Business Daily. I appreciate the hat and the nice autograph there from William O'Neill, a true legend. So with that gratuitous plug out of the way, thanks for joining me here tonight. Have a great rest of the night and best of success with your trades. Goodbye for now.